Good evening and welcome. My name is Aaron Burt, and I am a certified financial planner with the Certified Financial Group in Altamont Springs. This is the first of a series of webinars that Certified Financial Group University, or CFGU, will be presenting. At Certified Financial Group, we developed this concept of CFGU to help provide general education to the public about investment topics, and in doing so, hope to become your resource for all things financial. This webinar will be recorded and posted to our website with all of the future webinars as they occur. We will be taking questions during the presentation, but we'll be answering them offline, so feel free to type questions in the chat box or shoot us an email after the webinar is complete, and we'll be more than happy to answer any questions you may have. This first presentation is called Investment Basics 101, and we're going to discuss the basics of investment planning. We'll start by discussing some fundamental concepts, and then we'll review some investment options that are available to you and consider some general investment strategies. Finally, we'll spend some time discussing how you might go about allocating your investment dollars. And in the end, I hope that this overview will assist you in thinking about your own investment needs and may help you determine whether you may benefit from working with a certified financial planner professional. So let's begin. First, let me pose a question. What does investing mean to you? So some of you may associate investing with speculating or gambling on a volatile or uncertain value of assets in the hope of obtaining potentially higher returns. For example, trying to time the market in order to make a quick profit. And others may see investing as more of a long-term, methodical effort to save for the future. And in fact, investing is a little bit of both. All investing involves a certain amount of risk, including the potential loss of principal. And there can be no ironclad guarantee that any investing strategy will be successful. Investing also involves the potential growth of your money over time. So consider investing a carefully planned and prepared approach to managing and accumulating money. Investment planning is about discipline and patience, but it doesn't have to be difficult. So an important concept to understand when it comes to investing is the impact of inflation. Inflation has the effect of reducing the purchasing power of your dollars over time. According to the U.S. Department of Labor, the average annual inflation rate since 1914 has been approximately 3%. So at a 3% annual inflation, something that costs $100 today would cost $181 in 20 years. Think about that for a couple minutes. Well, maybe not minutes, but seconds. That's a lot. I mean, your purchasing power is definitely going down. But let's look at it from a higher point of view, more money. Let's say you have $200,000 stashed in your mattress. Assuming a 3% annual inflation rate, that $200,000 will buy you just over $108,000 worth of goods and services in 20 years, and less than $60,000 in purchasing power in 40 years. This means that if your investments aren't keeping pace with inflation, you're actually losing purchasing power each year. It also means that the real rate of return on your investments may actually be less than you think, something you'll need to take into account. Inflation has the general effect of reducing the real value of your investments over time. But compounding has exactly the opposite effect. Anyone who has a savings account understands the basics of compounding. The funds in your savings account earn interest, and that interest is added to your account balance. The next time interest is calculated, it's based on the increased value of your account. In effect, you earn interest on your interest. And many people, however, don't fully appreciate the impact that compounded earnings can have, especially over a long period of time. Let's say, for example, you earn $5,000 a year for 30 years. After 30 years, you will have invested a total of $150,000. Yet assuming your funds grow at exactly 6% each year, hypothetically, but because of compounding, after 30 years, you will have over $395,000. A very quick rule of thumb is called the Rule of 72. It's a quick way to help you estimate how long it will take for an investment to double in value through compounding. Basically, you divide the number 72 by the rate at which the investment will increase in value. The result is the number of years that it will take for the investment to double. So for example, if the expected annual rate of return on an investment is 3%, it would take about 24 years for the investment to double in value. You can also use the Rule of 72 to estimate the rate of interest you'll need to double your investment in a given number of years. So you just take 72 and divide it by the number of years. So for example, in order for an investment to double in value in 4 years, you would need an annual return of 18%. So the sooner you start investing, the more time your investments have for potential growth. However, waiting too long can make it very difficult to catch up. So for example, you invest $3,000 at the end of each year, starting when you're 20 years old. you will have accumulated almost $680,000, assuming a 6% annual growth rate and no tax, by age 66. And if you wait until age 35, investing $3,000 annually, you'll accumulate only about $254,000. And if you wait another 10 years and start at age 45 to start investing, you'll accumulate only about $120,000 by the time you're 66 years old. It's a huge difference starting early versus waiting. However, it's never too late, so don't be discouraged. I'm simply trying to illustrate the importance of acting sooner rather than later. So the first step in any investment plan is to identify your goals. What are you investing for? Many of us invest to accumulate funds for retirement or for a child's education, and still others invest for shorter-term goals, perhaps a down payment on a house or a new car. Still others invest to build a fund that they can access for unanticipated financial needs, illness, accident, job loss, etc. Of course, you may have all of these things as investment goals or something that I haven't even mentioned. But if you do have multiple investment goals, think about how you might prioritize them. Now, once you've identified and prioritized your goals, consider the time horizon associated with each goal. Because generally speaking, all else being equal, the longer your time horizon, the more aggressively you should or can be willing to invest. That is, investments that carry more risk and therefore potential greater return will tend to be more appropriate for those with long-term investment horizons versus those with short-term investment horizons. Why is that? Well, the longer the investment horizon, the more time you have to recover from any potential investment losses. The world of investing is very subjective. The investment plan that's right for you depends largely upon the level of comfort that you have when it comes to risk. You can't completely avoid risk when it comes to investing, but it is possible for you to manage it. There are two aspects of risk tolerance to consider. First of all, the capacity of your investment plan itself to absorb losses, and secondly, how comfortable you are personally with risk. The first aspect can be quantified. Basically, the more flexibility you have in your investment plan when it comes to potential loss, the more risk your plan can tolerate. For example, if you have a long investment time horizon, it does allow you to take on more risk than if you have a short time horizon. The second aspect, how comfortable you are personally with risk, is more of an emotional measure and depends on many factors, including your objectives, life stage, personality, and investment experience. Some investors are comfortable with a high degree of risk, while others can tolerate only minimal risk. Your individual risk tolerance is an important factor in deciding which individual investments are appropriate for you, as well as how your investment dollars should be allocated among different investment classes. Investors are typically grouped into three categories for purposes of discussing risk: aggressive, those who have a high degree of risk tolerance; moderate, and then conservative, those who are risk adverse. So moderate would be between aggressive and conservative. You're willing to take some risk, but not a ton. Now, when it comes to investing, there's a direct relationship between risk and return. That is, in general, as the potential for return increases, so does the level of risk or volatility. Or stated another way, the less risk an investment has, the lower the potential for return. So, for example, putting your money into a bank CD may have little risk, but it also offers less potential for return than purchasing common stocks. This is true for investment portfolios as well as for individual investments. The more aggressive you are as an investor, the more risk you may be willing to take. More risk means a greater potential return, but also a greater chance of loss. Conversely, the more conservative you are as an investor, the less risk you're generally comfortable with, and less risk basically means less potential return, but less risk also means less likelihood of loss. This is known as the risk-return trade-off. As much as we would like it, we can't have it all. There is a relationship between growth, income, and the stability of our investments, and when we move closer to one, we automatically move away from the other. This is the dilemma that all investors face. The key is to try to maximize returns at a level of risk that you're comfortable with. Now, there are several general categories of investments to choose from, and countless specific investment options within each category. So we're going to discuss cash alternatives, bonds, stocks, other investments, and funds that pool your money with other investors, such as mutual funds or exchange-traded funds or ETFs. But before we start talking about investment options, let's take a moment to clear up a common misconception. And actually, we see this a lot. Some of you think that your 401k plan at work is an investment. It's not. A 401k plan is a tax-advantaged vehicle that holds individual investments. The same goes for IRAs, 529 plans, and Coverdell educational savings accounts. These are tax advantage vehicles, and they're buckets that can be filled with individual investments. Investments that are held in these vehicles get different tax treatment than investments that are held outside of these vehicles. So we like to think of it like a shopping cart. An investment vehicle is basically your shopping cart. You walk through the store, you can put all sorts of different investments or groceries or products inside that cart. The vehicle itself, the 401k, the IRA, it's basically just the cart, and the investments are what you're putting into it. But we're not going to talk about the tax treatment of those particular types of investments today, but it is an important subject, especially since the tax treatment of long-term capital gains and qualifying dividends is typically more favorable than that for ordinary income. And since you'll need to understand how different investment options are taxed to make good decisions, you should discuss this issue with a financial or tax professional. Cash alternatives are relatively low risk, short term, and generally fairly liquid. In other words, you can convert them to cash quickly if needed. You might use cash alternatives to provide you with stability, to maintain a ready source of cash for emergencies or other purposes, or to serve as a temporary parking place for assets until you decide where to put your money longer term. A few examples of some cash alternatives include certificates of deposit, money market deposit accounts, money market mutual funds, and U.S. Treasury bills or T-bills. Each option offers different rates of return and varying levels of liquidity. Also, some cash alternatives, such as bank CDs and deposit accounts, may offer FDIC insurance, and others do not. Be sure you understand the type of protection available with each one. The advantages of investing in cash alternatives are evident. You receive reliable, predictable earnings, or interest, in an easily tapped source of funds with little risk to principal. The big trade-off here, though, is that you'll return very little because those investments return relatively low compared to potential return offered by other investment options that we'll talk about in a minute. In fact, the possibility exists that the return on these investments will not be sufficient to keep up with inflation. If that's the case, you'll actually lose purchasing power over time by holding these investments versus others. So next we're going to talk about bonds. And bonds are essentially loans, which is why they are called debt instruments. You, the investor, lend money to a government or a corporation. And the interest rate or coupon rate, which can be fixed or floating, is set in advance. And interest payments are generally paid semi-annually. Bonds are issued in denominations as low as $1,000. In addition to a set interest rate, the maturity date is fixed, ranging from 1 to 30 years. However, bonds don't need to be held until they mature, once issued. They can be traded among investors like any other type of security. Because you can buy or sell bonds in the open market, bonds fluctuate in price, selling at, above, or below their face value. If interest rates rise, new bonds and investment options are offered with higher interest rates, and existing bonds with lower fixed interest become less appealing. So when interest rates rise, existing bonds decrease in value. And in contrast, when interest rates fall, existing bonds generally increase in value. Generally, the longer a bond's duration of maturity, the more volatile its price swings. The most common types of bonds include U.S. government securities, agency bonds, municipal bonds, and corporate bonds. U.S. government securities are backed by the full faith and credit of the U.S. government and therefore carry minimal risk. We've already talked about U.S. Treasury bills. There's other Treasury instruments as well, including Treasury notes and Treasury bonds, both which pay interest semi-annually. You can also invest in bonds that are issued by agencies owned or sponsored by the U.S. government, and which may or may not have the full backing of the U.S. government, depending on the agency. Then there's municipal bonds, which are issued by local governments of states, cities, or towns. Specific authorities, like a state transportation authority, may also issue bonds. Corporate bonds are issued by private companies, and the volatilities of these bonds depends upon the companies that issue them and can range from very stable to highly volatile. Some corporate bonds are convertible and can be exchanged for shares of the company's stock. You can also purchase zero-coupon bonds that are issued at a discount below face value. No interest is paid, but at maturity, you receive the face value of the bond. For example, you may pay $600 for a 5-year, $1,000 zero-coupon bond. At the end of 5 years, you would receive $1,000. So what are the pros and cons of bonds as an investment choice? Let's take a look. Bonds aren't as safe as cash alternatives, nor are they as glamorous as stocks or commodities, but they're an important component of most investment portfolios. Bonds can provide a steady and predictable stream of income through interest payments for as long as you hold them. In addition, the income from interest payments is typically higher than for cash alternatives. They're also generally considered lower risk investments because bonds are legal debt obligations. The corporations must pay interest to bondholders before paying dividends to shareholders. Furthermore, in the event of a corporate bankruptcy, or if the corporation dissolves, it's obligated to pay bondholders first. And of course, securities issued by the Treasury are backed by the full faith and credit of the U.S. government. However, all bonds do carry some risk, and some bonds carry a great deal of risk. Bonds may also help you diversify your investment holdings. Bond values tend to move in the opposite direction of the stock market. By holding both bonds and stocks in a portfolio, you might be able to offset losses in one category while you get gains in the other. And with a bond, you can lose money if the issuer fails to make interest payments or is unable to repay principal. Bonds can also lose market value if the creditworthiness of the issuer declines. This type of risk is associated more with corporate bonds and less with Treasury securities, which are backed by the full faith and credit of the United States. Many bonds are issued with a fixed interest rate. As general interest rates fluctuate, so too will the value of fixed rate bonds. If interest rates drop, new bonds and investment options are offered with lower rates, and the market value of existing fixed rate bonds is likely to increase. Conversely, an increase in interest rates will generally cause a drop in the value of existing bonds. However, not all bonds have fixed interest rates. Bonds that have floating interest rates will tend to fluctuate less in value when there's interest rate changes. Finally, because bonds have lower risk than other investments, they also tend to offer relatively lower returns. The next option we're going to discuss is stocks. Stocks is what everyone gets excited about because that's what's reported in the S&P 500 or the Dow Jones Industrial Average every day when you turn on the news and they talk about how the markets are doing. But in general, when you buy company stock, you're actually purchasing a share of ownership in that business. The greater the number of shares you own, the higher the percentage of ownership you have in that company. Investors who purchase stocks are known as stockholders or shareholders. Your percentage of ownership in a company also represents your share of the risk taken and profits generated by the company. So if the company does well, your share of the total earnings will be proportionate to how much of the company's stock you own. On the flip side, of course, is that if the company does poorly, you also will share proportionately in those losses. Beyond that, depending on the company and the types of shares you have, stock ownership may carry other benefits. You may be entitled to dividend payments or capital gains payouts or other corporate privileges like voting for candidates for the board or other important corporate issues. If you purchase stock, you can make money in one of two ways. First, corporate earnings may be distributed to you in the form of dividends, usually paid quarterly. Secondly, you can sell your shares. If the value of the company stock has increased since you purchased it, you will make a profit. Of course, if the value of the stock has declined, you'll lose money as well. Generally, corporations issue two types of stock, common or preferred shares. Common stockholders have many rights, including the right to vote. However, they are last in line to claim the earnings and assets of the company. They do receive dividends at the discretion of the board, and after all the claims on profits have been satisfied. Preferred shareholders, on the other hand, are given priority over owners of common stock when it comes to dividends and assets. However, preferred stockholders do not receive all the privileges of ownership given to common shareholders, including the right to vote. Preferred shareholders typically receive a fixed dividend payment, and for preferred shareholders, there is less return potential because there is less risk. Common shareholders benefit more when the company does well, but they also may lose more if the company does poorly. Stock is commonly categorized by the market value of the company that issues the stock. So, for example, large cap stocks describe shares issued by the largest corporations. Other general categories include small cap, mid cap, or micro cap stocks. Stock is also commonly classified according to the characteristics of the company. For example, growth stocks are usually characterized by earnings that are increasing at a faster rate than their industry average. These are often new and fast-growing industries, and basically they don't pay out dividends, but they reinvest their profits into the company itself in order to accelerate growth. However, usually they are much riskier due to the fact that they are not paying out those steady dividend payments. Value stocks are typically characterized by selling at a lower multiple of company sales, and they will also generally pay out dividends to their shareholders. Income stocks offer higher dividend yields than market averages and typically fall into the utility, possibly financial sectors, as well as other stable and well-established industries. And blue chip stocks, in general, are large, well-known companies with good reputation and a strong record of profit growth. They also generally pay dividends as well. Also worth mentioning are ADRs, or American Depository Receipts, which are foreign stocks, which basically it's negotiable instruments today created to represent shares of stocks in non-U.S. companies. So you may hear that term ADR, stands for American Depository Receipts. The advantages and disadvantages of investing in stock basically depends largely upon the type of stock that you choose. In general, stocks offer a greater potential for returns than do bonds or cash alternatives. Historically, this has been particularly true for long-term periods. With stock, you actually own a share of the company and therefore have ownership rights that may include voting rights. And you can also invest in stock that has a history of paying regular dividends. You can also invest in stock that has the potential to appreciate significantly in value. And stock is very easy to buy and sell. Of course, if the company you invest in performs poorly, it may not pay dividends. Even if it had regularly paid dividends in the past, it could stop. Dividends are never guaranteed. More importantly, though, poor performance may result in shares losing value. And in fact, your shares can lose value simply because they're subject to the general volatility of the stock market, which has experienced sharp declines in the past. This volatility means that your risk of losing principal is greater with stock than it is with bonds and cash alternatives. It also means that the stock may not be appropriate for short-term investments, unless you have a high tolerance for risk. In general, if you have a short investment time horizon, investing in stock is generally not a good idea. Cash, alternatives, bonds, and stocks are the three major investment categories, but there are many other options, including real estate, but both commercial and residential, or real estate investment trusts. Then there's also stock options, which gives you the ability to buy or sell stock without actually taking ownership of the individual shares. And there's futures and commodities, which is basically speculating on the future value of something. So you may hear pork bellies or wheat or sugar or gold, or collectibles such as antiques, fine arts, collector cars, or anything else that may appreciate in value over the years. Because this is a basic investment discussion, we're not going to spend any time on these other types of investments. But if you'd like to discuss, I'll be happy to discuss them with you later. Mutual funds represent another way to invest in stocks, bonds, or cash alternatives. The principle behind a mutual fund is quite simple. Your money is pooled along with the money of other investors into a fund, which then invests in certain securities according to a stated investment objective. The fund is managed by a fund manager who reports to a board of directors. By investing in the fund, you own a piece of the total portfolio, which could include anywhere from a few dozen to hundreds of securities. This provides you with both a convenient way to obtain professional money management and instant diversification that would be more difficult and expensive to try and achieve on your own. Every mutual fund publishes a prospectus, and before investing in a mutual fund, get a copy and carefully review the information it contains, such as the fund's investment objectives, risks, fees, and other expenses. Carefully consider those factors as well before investing. One way to get all this information is basically just take the mutual fund ticker symbol, because like any stock, all mutual funds have tickers, plug it into Google, and you'll find more information about all those individual mutual funds than you probably ever wanted to know. But it's a great way to get the prospectus and other information about the mutual fund. So we've discussed the three major investment categories: cash, alternatives, bonds, and stocks. And many mutual funds limit themselves to just one of these categories. Commonly named and classified according to their investment style or objective, funds that invest solely in cash alternatives are generally called money market mutual funds. Funds that invest solely in bonds are called bond funds, and not surprisingly, funds that invest in stocks are called stock funds. Stock mutual funds can also be classified based on the size of the companies in which the funds invest: large cap, mid cap, and small cap. Of course, there are many other types of mutual funds. For example, funds that invest in both bonds and stocks are often called balanced funds. In fact, there are mutual funds that fit all along the risk-return spectrum. International funds, which seek investment opportunities outside the United States, are one example. An actively managed fund is one where the fund manager uses his or her knowledge and research to actively buy and sell securities in an attempt to beat a benchmark. A passively managed account, called an indexed fund, typically buys and holds most or all of the securities represented in a specific index. So, for example, the S&P 500. That is an index, and the mutual fund manager tries to replicate that index by buying the stocks within that index. And the objective of an index fund is to obtain the same rate of return as the index it mimics. Although the name of a mutual fund sometimes offers insight into its investment style and objective, don't rely on the name alone to determine whether a particular fund is what you want. You should read a fund's prospectus before you consider investing. Mutual funds do offer several advantages. The first is diversification. Because most mutual funds own dozens or even hundreds of securities, you get instant diversification with a mutual fund. Managers often spread fund assets over more than one industry or even more than one type of investment. So though diversification alone can't guarantee a profit or insure against a loss, holding many different securities reduces the impact of problems within a single individual security. If some of the fund's holdings perform poorly, they may be offset by others doing well. The next advantage is professional money management. Full-time expertise is part of what you pay for in buying shares of an actively managed mutual fund. The fund's manager analyzes hundreds of securities and makes decisions on what and when to buy and sell. The next advantage is small investment amounts. So depending on the fund rules, you can open an account and make subsequent contributions, oftentimes with as little as $50. You can even set up an automatic investment plan through a transfer of funds from your bank account. Next is liquidity. You can convert your mutual fund's investments into cash, or basically redeem your shares, by making a request to the fund company in writing, over the phone, or on the internet on any business day. On the other hand, mutual funds are not guaranteed investment. The price of mutual funds shares change daily, and you'll receive the current value of your shares when you sell, which may be more or less than what you paid. In addition, because investors in a mutual fund can withdraw their funds at any time, mutual funds tend to keep an amount of portfolio dollars in cash alternatives to accommodate for these withdrawals. These funds could be invested in investment options more suited to the fund's investment strategy and could drag on overall investment return. Also, fund managers don't take into account your individual financial circumstances. This can lead to some inefficiencies, particularly when it comes to taxes. So, for example, any short or long-term gain the mutual fund realizes from the sale of securities is passed through to investors, even if the investors don't receive any distributions from the fund. You can't control the timing. Finally, all mutual funds have expenses that investors must pay for. These include sales charges and the annual operating expenses of running the fund. You can find out about these fees, usually calculated as an expense ratio, in the mutual fund's prospectus. Read the prospectus carefully, as fees and expenses affect the fund's overall return. The higher the expense ratio, the more likely the fund's return will be lower than a similar fund with lower expenses. Like a mutual fund, an exchange-traded fund pools your money with the money of other investors and invests in a collection of securities. However, there are some key differences you need to understand. Unlike actively managed mutual funds, exchange-traded funds typically select investments according to a specific index. For example, as I mentioned earlier, the S&P 500. The fund's investment choices typically don't change unless the index itself changes. That passive management style and relative infrequent trading can help reduce the fund's costs for such things as management fees, research into individual securities, and trading fees for buying and selling individual securities. In this way, they are a bit like an index mutual fund. Even if ETFs may have passive management style, they can be useful to investors who want to trade it actively. For example, an ETF can be traded throughout the day, and its price may fluctuate as a result of that activity, just like a stock. This is different from a mutual fund, which is priced only once a day after the market closes. Also, an ETF can be bought on margin, sold short, or traded using stop orders or limit orders, just like a stock. ETFs are one way to invest in an individual market segment or industry without limiting yourself to a single stock or bond. Finally, because they trade relatively infrequently, ETFs may offer tax efficiencies. For example, they may make lower taxable annual distributions to shareholders. Like a mutual fund, each ETF publishes a prospectus. Get a copy before investing and carefully review the information it contains. Even if two ETFs invest in the same market segment, they may use indexes that are structurally different. As with mutual funds, before investing in an ETF, get a copy of the prospectus available from the fund and carefully review the information it contains, such as the fund's investment objectives, risks, fees, and expenses. Carefully consider those factors as well as others before investing. Many investors utilize an investment strategy called dollar cost averaging. With dollar cost averaging, rather than investing a single lump sum, you invest smaller amounts of money at regular intervals, no matter how the market is performing. Your goal is to reduce the overall volatility of your portfolio by purchasing more shares when the price is low and fewer shares when the price is high. Although dollar cost averaging can't guarantee you a profit or avoid a loss, a regular fixed dollar investment may result in a lower average price per share over time, assuming you continue to invest through all types of markets. You should consider your financial ability to make ongoing purchases regardless of price fluctuations, however. For example, let's say that you decide to invest $300 each month toward your child's college education. Because you invest the same amount each month, you automatically buy more shares when the prices are low and fewer shares when the prices are high. Over time, you'll find that your average cost per share is actually less than the average market price per share over the time that you invested. If you're currently contributing automatically to a 401k plan at work, you're actually already practicing dollar cost averaging. It is an almost universally accepted concept that any portfolio should include a mix of investments. That is, a portfolio should contain investments with varying levels of risk to help minimize exposure. Many investors make the mistake of putting all their eggs in one basket. For example, if you invest in one stock and that stock goes through the roof, a fortune can be made. On the other hand, that stock can lose all of its value, resulting in a total loss of your investment. Diversifying your investment over several asset classes will help reduce your risk of losing your entire investment. Now keep in mind, though, that diversification cannot ensure a profit or guarantee a loss. Asset allocation is one of the first steps in creating a diversified investment portfolio. Asset allocation is a concept of deciding how your investment dollars should be allocated among broad investment classes, such as stocks, bonds, and cash equivalents. The underlying principle is that different classes of investments have shown different rates of return and levels of price volatility over time. Also, since different asset classes respond differently to the same news, your stocks may go down while your bonds go up, or vice versa. Diversifying your investments over different asset classes may help you lower the overall volatility of your portfolio. So how do you choose the mix that's right for you? Well, a number of resources are available, including interactive tools and sample allocation models can be found online. Most of these take a number of variables that are some are objective, such as your age or your financial resources that you have, or your time frame or your need for liquidity. And some are subjective, such as your risk tolerance or your outlook on the economy. And they take this information and they then suggest a possible allocation mix. You'll want to choose a mix that has the potential to provide you with a return at the level of risk that you are comfortable with. And for that reason, it often makes sense to work with a financial professional who will gauge your risk tolerance, and then they'll develop a risk portfolio that matches your risk tolerance, and personal financial situation. Every individual situation is unique. Nevertheless, in general, conservative asset allocation models will invest more heavily in bonds and cash alternatives, with the primary goal of preserving principal. In comparison, a moderate asset allocation model will attempt to balance income and growth by allocating a significant investment dollars to both stocks and bonds. Finally, an aggressive asset allocation model will tend to concentrate more heavily in stocks, focusing on potential growth. So as you've seen, there is a lot to consider when it comes to investing. If you don't have the time, confidence, or inclination to put together an investment plan, you may benefit from the help and advice of a financial professional. A financial professional can help you determine your investment goals, timelines, and risk tolerance, evaluate markets and investments, create an asset allocation model that's right for you, select specific investments, manage and monitor your portfolio, and modify your portfolio when necessary. And this concludes the end of our Investment Basics 101 class. I see we have a number of questions, which, like I said, we will be answering offline after this presentation is over. If you have any other questions that you think of during the week, feel free to reach out to our office. Our contact information is on the screen in front of you. Here at Certified Financial Group, this is what we do day in and day out. So if you have any questions or any concerns, please feel free to reach out to us and explore our website as well, financialgroup.com. There's all sorts of tools that are available out there for you. Appreciate you taking the time to listen to our presentation this evening. Thank you. God bless, and have a great evening.